Hi, I'm Steve LaFrance with Blakely Financial, and I'm summarizing the past 30 days in 3 minutes. Stocks traded higher for a second consecutive month after another encouraging inflation report. CPI increased 0.4% month over month during October, which was a repeat of September's 0.4% and below the market's expectation of 0.6%. Year over year, CPI increased 7.8%, which was the slowest annual pace of inflation since January. And the fourth consecutive month, the pace of inflation slowed from the prior month. Investors wagered that this drop in inflation will allow the Fed to slow its interest rate hikes, so bond rates declined, bonds traded higher, and the fixed income index generated a 3.8% total return. The S&P followed up October's 8.1% rally with another 5.6% gain. International stocks joined in on the rally and significantly outperformed U.S. stocks as the U.S. dollar weakened some. Much of this was driven by the expectation that China may finally be relaxing their zero COVID policies, leading to their best monthly gains in almost 20 years. Overall, November was a strong month across many asset classes. A look beyond the S&P's headline return reveals strong breadth, with 8 out of the 11 sectors outperforming the broad index. In addition, 425 of the S&P's 503 stocks traded higher during November, with energy finishing last for the first time all year, yet still maintaining a dominant performance lead over all other sectors. This suggests investors are becoming more confident in the path forward, which we expect to remain fluid while markets continue looking for incoming economic data to support the latest rally. 263,000 jobs were created in November, and unemployment remained at a 53-year low of just 3.7%, with an annualized wage growth of 4.7%. Q3 GDP was revised up to 2.9%, showing we have a strong economy, even if real estate's not presently participating after its torrid pace in 2021 and early 22. And all of this mixed data is what fuels the daily debates over the Fed's actions to curb inflation and the market's guessing game for Jay Powell's terminal rate. Just last week, he was quoted as saying, "The Fed will need restrictive policy for some time," while also saying, "The time for moderating rate hikes may come as soon as December." After 4 consecutive increases of 75 basis points, many are interpreting this to mean the next rate hike may only be 50 basis points, with a goal of getting to 5%. We're not going to pretend to know what comes next, except to say that markets have historically done well in December, and will still likely finish the year with negative returns. As investors, we always preach the merits of staying the course and focusing on the long term. The past couple of months have reinforced how it's impossible to time the markets, and we'll never know when the bottom is in until after it occurs. Now is an excellent time to reposition portfolios for future growth. Consider opportunities for tax loss harvesting. Take advantage of increased retirement plan contribution limits. Confirm RMDs have been satisfied. Consider charitable distributions, and give all your financial plans a review. As always, we appreciate your trust and confidence and hope you have a safe and happy holidays.